Hello and welcome to the lecture for part 2 of chapter 6. So in this section I'm going to talk about the sales side of things. In the last section I talked about purchasing inventory. Now I'm going to talk about selling inventory. So for merchandising companies, revenue is recorded as sales, and this is really important. Every time a sale of physical product is made, we're going to record two journal entries. One to record the sale and the increase in either cash or accounts receivable. The other entry is going to record the cost of that sale. So we're going to record the cost of merchandise sold, and we're going to reduce our inventory because we've taken product off the shelf and given it to a customer. They've left with it, and we no longer order it. So in this case here, we sold $18,000 worth of product to Digital Technologies. We increase accounts receivable and we increase our revenue by crediting sales. At the very same moment, we record the cost side of invoice 7172. Those goods that we sold the customer for $18,000 cost us $10,800. So we increase our expense, cost of merchandise sold, by debiting that account, and we reduce our inventory by $10,800. Again, this second entry is done only when we have a perpetual inventory system where we're recording cost as we make the sale. Now, just as we had prompt payment discounts when we purchase products, sellers also often offer prompt payment discounts to their customers. So if that's the case, if we offered Digital Technologies at 210 net 30 prompt payment term, and again, it could be 115 net 30, it could be 220 net 30, there could be a variety of different terms. 210 net 30 is the most common. In that case, we would record the sale as the net of what we expect to actually receive. So we assume that customers are going to take the discounts we offer them. So in that case, we record the sale at $17,640, which is $18,000 minus 2%. When we receive the cash later, we debit cash and credit accounts receivable. Pretty simple. Now, the one thing that's a little bit tricky is sales returns and allowances. So whenever we sell physical product, we recognize that some portion of that might be returned to us, or some portion might arrive damaged, and we have to give an allowance for it down the road. And for proper matching, we want to record that impact in the period in which we make the sale. And we would do this based on either historical experience, or for a brand new business, we would base it on what an industry average might be. So in this case here, let's say that we assume that 2% of our sales are normally returned to us in a subsequent period. So at the end of the period, we would take our total sales, in this case it was $2 million in this example, and we would reduce our sales by 2% of $2 million. So we'd say we didn't really sell $2 million, we sold 2% less than that, $1,960,000, because some of it is going to be reversed when it comes back to us in a later period, but we want to recognize it in this period. And we create a liability called customer refunds payable that we can use to pay those refunds in the future and not have it affect the income statement for future periods. We also, just like when we record a sale, when we do this, we need to record two entries. One to reduce our sales and record a payable. The other to recognize that we have some inventory floating out there in the world that's going to come back to us. That's called estimated returns inventory, and we reduce our cost of goods sold, because we're going to reverse some of the sales that were made. So if we reduce sales, we also want to reduce cost of merchandise sold. Later, when we get a receipt of returned inventory, we issue a credit memo to the customer. We take that out of the customer refunds payable. So in this case, we pay a customer back $3,000 to give them a refund for product they returned to us. So we reduce our liability that we established by debiting that account for $3,000, and we reduce our cash by crediting that for $3,000. Again, we also make another entry to record that we now have $2,100, that's our cost of merchandise that came back to us that we put back on the shelf to sell to other customers, and we credit that estimated returns inventory, the inventory that's floating out in the world that's eventually going to come back to us. We reduce that with a credit. I mentioned earlier when I showed you that sample invoice in the first lecture, the first part of the lecture for this chapter, that FOB stands for freight on board. It determines where the transfer of ownership takes place. And there's generally two terms. There's FOB shipping point, which means the sale takes place at the seller's loading dock. That means it becomes the customer's merchandise the moment it crosses the loading dock and is put in a truck. That means that if that truck crashes on the way to the buyer, it's the buyer's problem, okay? And so in that case, the sale takes place the moment it crosses the loading dock. So let's say I buy, say I run a garden center and I'm buying some benches and I buy them from Tampa, Florida, and the terms are FOB shipping point. Maybe they ship on December 29th, and at the end of my year, December 31st, those benches are somewhere in Missouri on their way to me from Tampa. Well, those are my benches. That inventory became mine on December 29th when it crossed the shipper's loading dock. And so I need to count that in my inventory, even though I don't physically possess it yet in my warehouse. So the timing of when we recognize a transaction is dictated by the shipping terms. The other type of shipping term is FOB destination. That says that the transfer of title occurs at the buyer's doorstep. Any of you are Amazon Prime customers, this is an example of that. So Amazon pays the freight, it's their goods until it gets to your doorstep, and then it becomes your goods. So that's going to affect the timing. The other issue is who pays the freight. If it's FOB shipping point, it means the buyer is going to pay the freight. If it's FOB destination, it means the seller is going to pay the freight charges to get it to you. So again, keep in mind when we're calculating how much we actually owe for different invoices, that's some of the homework problems, that we're not going to apply any prompt payment discounts to freight charges when the customer is charged for freight. So there is symmetry between how a seller records a transaction and how a buyer records a transaction. So let's walk through some of these. So in this case, Scully Company is the seller, Burton Company is the buyer. So on July 1st, Scully Company sells merchandise to Burton Company for $7,500. Terms FOB shipping point, net $45, so there's no prompt payment discount. The cost of the merchandise to Scully is $4,500. So Scully, the seller, records those two journal entries, one to establish the receivable and increase sales, the other to record the cost of the sale and reduce inventory. On the buyer's books, they debit merchandise inventory and credit accounts payable. So notice the accounts receivable from Burton Company on Scully's books of $7,500 matches the accounts payable on Burton's books. So on July 2nd, Burton pays the freight charge, and so there's no recorded entry on Scully's books. Burton increases their merchandise inventory account and credits cash. That causes the inventory to be valued at what the net cost it occurred for Burton to get it to their shelf. On July 5th, Scully sells merchandise to Burton for $5,000. Now the terms are FOB destination, net $30, and the cost of the merchandise is $3,500. So in that case, we do the two entries on Scully's books, we do the entry on Burton's books as we did in the first example. And then when Scully pays the freight charges for delivering that merchandise to Burton Company, they record delivery expense, which is a type of operating expense for Scully, and Burton didn't incur any freight charges. They don't have an entry to record. Then Burton pays Scully for that first invoice that was issued. So Scully will receive $5,000 of cash and reduce her accounts receivable. And Burton does the opposite. They debit accounts payable to reduce their liability and credit cash. This next transaction, Scully sells merchandise on account to Burton for $12,000. Terms FOB shipping point, $210 net end of month. Scully Company prepays freight of $5,000 and adds it to the invoice. Okay, and the cost of the merchandise is $7,200. So in this case here, we record accounts receivable for Burton and sales, and that's a net of the 2% discount. We also increase accounts receivable for the $500 we pay the freight company if we're Scully, and we record the cost of the merchandise and reduce our inventory. On Burton's books, they record the net total of $12,260 for the merchandise. That's $11,760 plus $500, and they create an accounts payable showing that they owe that money to Scully. Then that is paid at the end of the month, or on July 28th rather. So sales taxes are also something that needs to be taken into account. Any of you that have purchased something at a retail store know if you see a price tag on an item and it says $100 and say you buy it in downtown Olympia, the amount that you pay is not $100. It's $109 or $109.50 or something. So in that case, we're going to record if we sell product that's subject to sales taxes and the end user is who pays the sales tax, we're going to increase accounts receivable. We'll record the sale not at what we're collecting from the customer, but what the price of the goods are. And then we create sales tax payable. That's the amount that we have to pay to the government at the end of the month or the end of the quarter, depending upon what the timing is from when we pay that. The business here is simply a conduit. They're collecting money from a customer and forwarding that money to the state. It's the business's responsibility to collect that money and pay it to the state. If they forget to collect it from a customer, they're still obligated to pay the state for the sales tax on that particular sale. So we accrue that liability as we make sales, and then again at the end of the month or the end of the quarter, depending upon the timing, we pay the sales tax to the state. So we debit sales tax payable and credit cash to reflect that we've remitted that to the state. A little bit on financial statements here. So you notice this financial statement is a little bit more complicated than the ones we've been looking at. As I mentioned earlier, we have a couple of new line items here. So we record sales. That's the net amount that we have charged customers for our product, less what we think we're going to get in returns in the future. We subtract cost of the merchandise sold to get gross profit. And again, that number is very, very important for merchandisers, both as a dollar amount and as a percentage. The other thing that's done a little bit differently here is notice we've broken out selling expenses into two categories: selling expenses and administrative expenses. And within each of those categories, we record the expenses in diminishing order, with miscellaneous being last regardless of the size. So we show the subtotals. This breakout gives us a little bit more information for looking at comparative businesses and saying, how do these businesses compare to each other, both in terms of their gross profit percentage, which is important, but also how do their selling expenses compare relative to their sales. In this particular company, their selling expenses are approximately 10% of what their sales are. So that would be interesting to compare that to another similar business. Administrative expenses are what you commonly think of as overhead, office salaries, rent, those kinds of things. So that's total operating expenses. That gives us income from operations. That's what is the result of the core purpose for which we're in business. And then we subtract other income and expenses that aren't part of our core purpose of being in business. So in this case, we have a little bit of rent revenue. We might have an empty storage unit that we rent out to someone else. Well, that's probably not the business of Net Solutions. Their business is buying and reselling computer components, not renting out space. So we're going to record that below income from operations so it doesn't kind of cloud the picture of how we're doing in our core business. Interest revenue and interest expense are also shown down below that line because we're not a bank. We're not in the business of borrowing or lending money. So we record that separately, and that gets us to a bottom line net income figure. The balance sheet is different in the sense that we have a new account called merchandise inventory. And again, as I mentioned earlier, that's going to be a current asset because we expect it to be turned into an expense within the upcoming 12-month window. And in terms of its location within current assets, it's usually right after accounts receivable because it's a little less liquid than accounts receivable would be. In order to turn merchandise inventory into cash, we first have to sell it, which creates an accounts receivable before we collect the cash. Finally, there's an adjusting entry that merchandising companies make at the end of usually at the end of a fiscal year, which is they take an annual physical inventory. So even though they may have a perpetual system and have a theoretical level of inventory for every component, they are required to stop at the end of the year and do a wall-to-wall count of all inventory. This inevitably will show us that we don't have quite as much inventory on the shelf as what our perpetual records would indicate we should have. That's due to inventory shrinkage, and that can happen for a couple of different reasons. It can happen because of theft, of course. Somebody could shoplift something or whatever, and of course that's not recorded in the accounting system. And it can also happen because something may fall off a shelf and get damaged and somebody throws it away and they don't take the time to record that in the system. It can also happen because of errors. Maybe a supplier sends us 100 items, but we really only get 98 and we record it as a receipt of 100, that sort of a thing. So there could be errors and theft that cause inventory shrinkage. So when we take the inventory count at the end of the year, we're going to get a slightly different figure than what our perpetual inventory shows, and we need to record an adjustment. We do that by debiting cost of merchandise sold and crediting merchandise inventory to bring the value in merchandise inventory down to what the correct level is based on our physical count. So hopefully you found that lecture helpful. If you have any questions when you're working through the homework, please don't hesitate to reach out to me. And again, I would really recommend doing the practice problems before you tackle the homework for this chapter. Thank you.